Hi, good morning, good day, good afternoon. This particular video presentation is going to be about the balance of payments. Okay? And it's very important. It's a very important concept that we understand, so we could fully be aware of the implications upon the countries that we live in. So to begin our discussion, we need to understand what is a balance of payments, short BOP. Now, just like a firm needs to keep record of transactions of the receipts and payments made between themselves and their respective clients, similarly, a country, which can be seen as a financial entity unto itself, a country also needs to keep a record of transactions that occur between that country in itself and other countries in the rest of the world. So, what we realize, therefore, is that a balance of payments can be defined as the accounting record of all monetary transactions between a country and the rest of the world. Now, this statement implies that firms in one country can therefore interact via trade with firms in another country. So it brings to the forefront the concept of closed and open economies. Now, if we draw our minds to many years ago, we would realize that the world was not as connected as it is today. Today, we are very connected simply because of the World Wide Web, the internet. But long ago, trade would have been restricted to taking place within a country, within a physical geographic location, because of the lack of transport, transatlantic trade, because before there were boats to these big ships to transport goods across, or even planes. Trade had to remain within a physical country, and therefore such an economy will be described as being closed. When you live, so for instance, if in your own particular country from where you're from, trade takes place between consumers and producers of that country alone, no goods are brought in from outside and no goods are sold outside, then such an economy is described as being closed. It's closed to outside interaction. However, as I said, now because we have a lot of the technological advancements that took place in the world today, we would often hear the term that the world is a global village. And as a result of this, it allows trade and economic activity to take place across countries. And therefore, countries that are capable of trading with other countries via importation and exportation are defined as open economies. And we realize that the majority, if not all countries in the world today are open, because you would see commodities coming in from other countries. For instance, if you live in the Caribbean here, you realize that there are a lot of international products in your local Caribbean island from the US, from the UK, and possibly if you go abroad, you may see some of your own Caribbean island products abroad in the US and in the UK. So you realize that there is a swapping of goods, and not simply goods, but also services. We are aware that sometimes when our family members go abroad and they live or they work for a while, monies can be sent back and forth from country to country, and all of these things will be recorded in the accounting book for the economy, which we previously defined as the balance of payments. So therefore, the economic agents that exist in a closed economy, in a country that does not have any international trade, would simply be the households, firms, and the government. Right? The households, the firms, and the government. Whereas in an open economy, you now have the households, you have the firms, you have the government, and you now have the foreign sector. And we have these variables here which represent the economic activity of each of these economic agents. So let's delve into the economic activity. So we know economic activity can be defined as all of the activities that pertain to production, consumption, and distribution of goods and services within a society. So the economic activity of households can be seen as consumption and is it is represented by this letter C. Firms, the economic activity of firms would be investment, because the firms desire to make a profit or to maximize their profits, and therefore they have to invest some monies in order to be able to make that profit. And therefore the government, the economic activity of the government will be government expenditure, as the government spends money to increase the level of welfare of their citizens. So in a closed economy, again we said households, the firms, and the government, and their representative economic activity would be consumption for households, investment for firms, and government expenditure for the government. Whereas in an open economy, as we stated before, we now include the foreign sector, and the economic activity would be net exports. And net exports is the difference between what is exported by the country and what is imported by the country. All right, so we call it net exports. So having an understanding of what an open and a closed economy is, we can now go back into our discussion of the balance of payments. And however, before we do that, let's look at the issue of savings and how savings could be allocated in an economy, how it's allocated in a closed economy, and how it's allocated within an open economy. Now let's think about it this way. All of our income, all of our disposable income, and our disposable income is income after we have been taxed, the income that we have remaining to spend after taxes are paid. So all of our disposable income is either done one of two things. You either consume, C, or you save. You either consume and spend on consumption, or you save. All right? Or you could do both. You spend a little on consumption and you save a little. But at the end of the day, you have those two broad options. Now, any money that remains in savings will now be accessible through the facility of banks, can now be accessible in the form of loans, because money saved means that someone else who may not have money but would like to spend something would have to borrow, and therefore they can access savings, which can therefore be used as investments for that individual who's borrowing. So we realize therefore that the monies that are available in an economy in the form of savings can be transformed into loanable funds, and these funds can now be loaned to people who want to borrow and therefore invest. So we realize that there is a mutual relationship between savings and investments, and barring all other factors, we can say or assume that the level of savings in an economy will be equal to the level of investments. Given this, we have here in a closed economy this equation: y is equal to c plus I plus G, which we know is the accounting equation for GDP, or for output within an economy. And what we're saying is that the output or the income of a country is as a result of money spent by consumers, which we represent as C, money spent by the firms, representative by investment, and money spent by the government, representative by this letter G, government spending. And therefore, if this here represents the total income and these represent spending, and we just simply stated that investments equal savings, we can therefore seek to make I the subject of the formula in this equation. As a result of this, by making I the subject of the formula, we now have y minus c minus g, because you're carrying the c and the I across on the other side. So the plus c and the plus I now gives us a minus. So y minus c minus g gives us I, which we are saying here that investments, funds that are available for investment, will occur after you minus your money spent on consumption and money spent by the government. Because what we're looking at here is national income. So national income minus consumption by households, and government expenditure, the remainder, of course, will therefore be national savings, which is equal to investments. Now, we need to break this down a little bit more because we want to account for taxes. So if we include taxes, which is representative by T, in our particular equation, it therefore means, from a mathematical point of view, since the T was not there, we have to both minus the T and add the T. So minus T plus T is actually 0. So you realize that this does not affect the equation. Now let's pair it together to make sense to us from a mathematical and an economical point of view. What we're saying here, when we put this first T here, with Y minus C minus T, what we're saying is that the income in a country, right, the income of the private citizens of a country is allocated between consumption and paying taxes. So this Y we see here is actually gross income. This is not disposable income. This is gross income. So when you minus taxes from gross income, you get disposable income. So again, what we're saying is that when you have your gross income, you minus your taxes and you minus your consumption, and therefore the balance will be your savings, your private savings. And therefore here we have taxes. The taxes that you took from the citizens, the private citizens, now comes as the revenue for the government, and therefore the revenue of the government is the taxes minus government spending. If anything remains that is positive, then that will be the savings for the government, and therefore that's why we can now say that private savings plus government savings or public savings is equal to investments, where we proved before that savings always equals investments. We see that working out here. Y minus C minus T is equal to private savings, S raised to P, and we have public savings, T minus G is equal, and we have here the variable SG. So what we're saying therefore is that SP plus SG is equal to SN. Private savings plus public savings is equal to national savings. And what we're saying is that the national savings in an economy can be now accessible to be used or allocated towards investing within that economy. But that's in a closed economy. When we put it in an open economy, we have to add one other element: net exports. So if we go about the same thing by going about the same process, what we realize is that carry across the C and the G, and we include the T, we get the same process: Y minus C minus T, which we said is our private savings, plus T minus G, which is public savings. What we are now saying is that national savings in an open economy can now be allocated towards investing in the local economy and investing in the international economy, which is net exports. So you can either invest in goods to export abroad, or you can invest in importing goods from abroad, because remember, net exports means exports minus imports. So what we have shown here actually is that savings in a local economy can be used towards investment, totally investment and investment alone if your economy is closed. But as we realize in today's world, most if not all economies are open, and therefore what we have is that savings in a local economy, the national savings in a local economy, can be utilized for local investments and also for foreign investments by either exporting goods that have been produced locally or importing goods from abroad. So we're now entering into the discussion of the components of the balance of payments, and we will continue this discussion in another video. Thank you.